Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, December 2nd, 7:45 a.m. Mountain Time. This is the introductory version of our weekly summary of our weekly note. Our note this week was titled A Whole of Government Approach. We began the note by offering a review of our 2024 outlook because this week we're going to spend all of our time, or the bulk of our time, on the 2025 outlook and get that note out on Saturday morning ahead of a trip to New York and Boston next week. So last year we thought that core inflation would come down, but would prove sticky and would be closer to the top end of the Fed's comfort zone between 2 and 3%. Obviously, their target's 2, but getting it down within the range of 2, we thought was crucial to beginning the recalibration, is what they ultimately termed it, process or easing process. But we thought that the real trigger would be the unemployment rate going up 4%. That turned out to indeed be the case, although they started later than we expected in September rather than March. We are on track to get the 100 basis points that we expected when they cut another 25 in December, which we think is pretty highly probable. We'd place a higher probability on that than the market discounted probability, which is about 65% right now. We thought that earnings growth would disappoint a little bit, and that's certainly been the case in the third quarter. It was not so much the case in the first half of the year. We thought that the S&P would have a good year, but not a great year. We were essentially bearish the Treasury market for the bulk of last year, other than a couple of points when we added some duration ahead of the growth scare that occurred during the course of the summer. And then again, we've added duration now. So the real gist of the note this week was our idea of a whole of government approach to dealing with the debt next year. By that, we mean we're going to essentially need coordinated action between the Cent Treasury and the Powell Fed. And what we would like to see them do, and think they may very well wind up approaching this, is the Fed ultimately will cut the policy rate more than they would have done otherwise, certainly in a Yellen Treasury where they continue to issue an excessive amount of bills, which drains liquidity and forces them to stop QT. So we're trying to essentially think about Treasury issuance, which we would expect the percent Treasury to start extending duration. So issue fewer bills, more notes and bonds. This will allow the Fed to continue QT because those bills drain liquidity from the system and could start to add volatility to overnight repo rates. If they issue more coupon securities, the Fed will be able to continue QT for a longer period of time. That will mean they'll be removing duration from the market at the same time Treasury's putting duration into the market. The aggregate setting, even though the policy rate would come down more than it would otherwise under this coordinated approach, would actually be much the same, but it will even the distribution between small businesses and large. We've been complaining about this for 18 months, that the way the Fed conducted policy put all the burden of reducing demand on small businesses and small banks. If the Fed were to cut the policy rate to say 3, Treasury extends its issuance, that evens those costs across the curve, and means that long-term fixed rate borrowers might have higher rates than they would otherwise, but the short-term small businesses, which is at the foundation of our economy, would get some relief. And ultimately, this is a much more sustainable approach. We get a sustainable disinversion of the curve. And we think the market could actually reward borrowers in the long end, like mortgage-backed securities, for example, where the spread is quite wide to Treasuries right now. We actually think that would tighten in this scenario where we get more coordinated action between the Treasury and the Fed. So this might be a little bit of a wish list, but we do think that they'll get around to approaching it this way. So the big data this week is the labor market data. We do expect an uptick in the unemployment rate. I think the market's with us on that expectation. That should lock in a December cut and perhaps a January cut as well. And then we'll get to next year's policy next year. So that's it for me. This would be a great time to consider becoming a full paid subscriber. You'll get our 2024 Outlook note. 2 weeks after that, we'll write our secular thematic report, which is one of our favorites for the year, and then our year in review note. And of course, what you get through the course of the year is guidance and changes in all of these viewpoints. So please consider becoming a full subscriber. Barry Neff from Ironsides. Thank you and have a good week, everyone.